Headline of the show, Berkshire Hathaway. You may have heard of it.
Yeah.
Warren Buffett's company made a $8.5 billion bet into housing. And what we mean by that is, I'm going to share the article here. They have recently acquired a company by the name of Taylor Morrison. It is a home builder, right? They acquired a home builder for $8.5 billion. And then they have doubled down. That was a couple of weeks ago. Now they've also doubled down. Berkshire, another one of their companies, Clayton, had another home building group, McGinn Homes, Tumungo, as like the scale race widens. GC. When you see these kinds of like moves being done by Berkshire Hathaway, what are you thinking?
Well, I back to how does Warren Buffett, how does Berkshire Hathaway make decisions? They make decisions to invest in value. Long-term value. So whenever you are holding the asset that then Warren Buffett comes in and makes a $8.5 billion play in, that should make all of us who own real estate feel really good about the long-term value of buying and holding real estate. To me, that was the first thing that I thought. All right, you know what else I thought of? There's a clip, I think Buffett was on CNBC.
First thing I thought of.
Right.
Yeah.
You know, and it happened, it was probably, 2020 or 2021. And it was Warren Buffett. And they said, hey, what do you think about buying single family homes? And he said, man, I wish I could just add a few thousand single family homes right now. I think it's a really great investment. So it's now it's not as easy for him when you're at that scale. It's not easy to go and add, single family homes.
Yeah.
But this is, following on that vision where he has seen value in housing for quite some time. Right now, he sees a lot of value to be able to buy not just one nationally renowned home builder, but it seems like it's the first of potentially many.
I see Berkshire Hathaway as a company that invests in fundamentals. And when we talk about the fundamentals here, we continue to talk about this idea that single family homes are a undersupplied critical need for America. I think it's a pretty telling thing that, correct me if I'm wrong, I don't know if he's seeing bottom of like a market, kind of like we talk about the real estate cycle. Maybe he sees like the worst times are behind us, or he's just like, man, this is just a no-brainer of which price I can get into to get into this like undersupplied asset.
Yeah, I mean, if you follow Buffett, he's less about timing the market. He just acts and usually acts big when he sees value, right? And that's probably what he sees right now. So while he might not be predicting the bottom, or it may be the bottom, I don't think really cares. He certainly thinks the prospects for home builders are strong over the next 3, 5, 10, 15, 20 years.
Yeah.
And I think that lines up with what we've been sharing about what you can expect on the other side of higher interest rates. When interest rates do come down, it's very, very predictable that when interest rates start to come down, those buyers that are sitting on the sidelines come back in. That leads to a rush of demand, a rush of sales, and typically leads to higher home prices, higher than normal home price appreciation in a short period of time as the pendulum swings. So we still are in an environment where interest rates are higher right now, but I think what Buffett and Berkshire are telling us is think about the prospects for home buyers on the other side of higher interest rates. What does that mean for the assets that we're holding? It's a good thing. It's a good thing because ultimately means that we're likely to see more demand, more home sales, higher home price appreciation, which is the single greatest way to drive your return on investment. So it's a good thing. It's a very good sign for all of us sitting here who own rental properties.
With that being said, right, like they're not the only ones predicting this stuff. Recently, Fannie Mae has also come out with a prediction of their own on this type of stuff. They're predicting a shift in home sales, real estate market. And they're basically saying their forecast points to gradual improvement in parts of the housing market, even as rates and affordability remain challenging. The forecast points to improving home sales, home price appreciation, mortgage originations, and broader economic growth. So, to me, this is another data point of there's people with great data, there's people with, like great reach. They're all pointing in kind of like a similar direction of maybe the worst times are behind us in the housing market, which we've all kind of like trudged through for the last year and a half.
Yeah, I think so. The worst times that we're talking about, again, are like flat growth. we should just preface that. But yeah, the interesting thing about Fannie Mae coming out in this report, and you're starting to see this in other reports, is it's not the first time that somebody or an entity has predicted that things will get gradually better for home sales and home prices and all of those things. But those reports are coming out this year and last year. Those reports were also paired with, we expect interest rates to go down, and we expect things to get better. Now you're starting to see reports. This one, I actually looked at the data, and they're still expecting interest rates to be over 6% in their report. So now they're signaling, well, we think things are going to get better, even if rates stay the same. We don't need this large decrease in their minds and their statisticians and economists to put it together, to put a model together and a projection that says sales are still probably going to go up. Home price appreciation is still probably going to grow. So I think that's the big shift we're starting to see, that this might be the new normal, and the real estate market can grow, and some are predicting it to grow even if nothing changes from an interest rate perspective.
Makes sense. I mean, you don't have to go far in this article. I just scroll down to these key points of new construction remains limited by labor shortages, inflation, and slow permitting. Real estate investors can expect higher costs and long rates. And it just kicks off this idea of like mortgage rates is on everybody's mind, but it's not the only thing shaping trends, right? Like it's this supply demand dynamic that will, when you're dealing with a critical need that takes so much to bring to market, right? Like you just can't pop it up the same way you can with multifamily and other things. And we've just chronically been behind before. So now we just continue to lag, and it continues to like come. So at some point, even with all the haymakers thrown at it, normalize, right? Like you said, a new normal, reminds me of the numbers that you were starting to share at the last market update that we can kind of like talk about here, of like what's going on in Jacksonville, kind of mirrors this stuff, right?
Yeah, so I had been putting, I always review the monthly market numbers here. I don't always bring them up to you guys on the show because we do it once a quarter, and it's a good holistic view. But as I was looking at the numbers, even before we started to prepare for these headlines, I was like, there might be the new normal that we're talking about, when I was just myopically looking at the Jacksonville data. And I thought it was interesting enough to bring it up, put it on our show prep. And I said, hey, I want to show everybody what the month over month data looked like just for June. And I think what you'll see is, as we have pulled some of these headlines out that are just real and I think significant with Berkshire and with Fannie, you're going to start to see some correlations here. So we're going to go from the macro to the real micro. 1 month, Jacksonville. And because I do think it's noteworthy. So the way to analyze the market is you look year over year. And I just looked June 2025 to June 2026. And here's what you see. So for the median home sales price in Jacksonville, $375. That's noteworthy because that is the single highest median home sales price in Jacksonville history. That is the new high of any month. So so I saw that and I'm like, what else do I see? Well, median days on market, 35. It was 37 before. So that means, how long does it take for a house to sell when you put it on open market in Jacksonville, put it on the MLS to sell? On average, it's taking for a median days, it's taking 35 days. That's low and going lower. Here's some of the real interesting data, why I wanted to show you. Year over year, we've seen 4.9% home price appreciation here in Jacksonville. So from June 2025 to June 2026, it's about 5% home price appreciation. It's been a while since we've talked about 5% home price appreciation.
In a while,
right? Noteworthy there. Now that's just 1 month. What I like to do, and what most professionals who know how to analyze home price appreciation will do, is you don't want to just rely on 1 month of data. That's not a good way to analyze the market. You want to go a little bit farther out just to smooth it over. So we go a 6-month trailing year over year. We take the year over year growth for the last 6 months and average it out. And so you're seeing a number here that's just higher than we've been reporting in previous months as well. So 2.5%, 2.3% is what the 6-month trailing home price appreciation is.
I mean, not long ago, that was like 0.5%?
Yeah, exactly. Yeah. It was just about break even for the longest time. So when you see 2.3%, which is taken the last 6 months on average, and you see the most recent month is 4.9, what that's indicating is that it is likely that you're going to have some home price appreciation for the overall market in Jacksonville in 2026 when the dust settles. Months of inventory, incredibly low. are down inventory about 15% year over year.
Okay.
Problem a year ago.
Yeah.
Supply was a problem
Yeah.
a year ago.
Yeah.
Berkshire Hathaway is looking at supply now much beyond Jacksonville, but if we just use this as a case study, we're looking at it a year ago and saying, well, supply was low. In many markets like Jacksonville, inventory is actually down this year compared to last year by about 15%. And that leads to a low month of inventory, which I know home sales are down from where they were 3 years ago, but if inventory is down and home sales are still relatively kind of where they were a year ago, ultimately that gets you to a lower month of inventory and leads to this home price appreciation.
Yeah.
So when you've got the supply problem and the supply problem is only getting worse, what that does is it creates a high floor for pricing and leads to increased home price appreciation.
Yeah, man. I mean, like when you look at it in a snap, it looks great. When you look at it as kind of like this kind of trend that's happening now, of year over year price appreciation from like January to February to March to April to May. And you see this chart, right? Like for those of you listening on the podcast, January was 0.3%, February was 0, March was 2.8, April was 1.4, May 3.9, now June 2020. This is 4.9, right? So this is like the monthly snapshot. This is not trailing 6 months.
Correct.
This is what makes up the trailing 6 months.
Exactly. Yeah.
So you see 6 months is at, in the twos, but like what you see is a positive trend over the second half of those 6 months versus the first half of 6 months.
That's exactly right. And just to clarify, we take year over year for each of these points in time. So it takes seasonality out of the equation. You're looking at comparing January 2025 to January 2026, and you had 0.3% home appreciation. You do that for each of those months. So yeah, you're starting to see a trend here.
Yeah.
And I think this is noteworthy. This isn't to say that home price appreciation is going to be gangbusters, but the biggest thing to help all of you who are thinking about investing in rental properties is to help you have confidence that this market has a high floor, right? If you feel confident that this has a high floor, you're much more likely to take action and add to your rental property portfolio right now. And so when I see this, I actually think that this is setting us up for additional home price appreciation more than we probably expected.
Yeah.
Because that's what the trend is indicating. We'll see what happens. I don't care if if it's continues to go up and it's 3% or 4% or 5% or 2%. At the end of the day, it doesn't really matter because we're buy and hold investors. But what I want to do is I want to keep moving people off of the fear, train of thought, right?
Yeah.
Because if you fear, when it comes to something that is consistent, like rental properties, you miss out on time.
Yeah.
And, when you miss out on time, that delays your financial outcomes. And so I think all of the things that we're seeing here hopefully help everybody to move from the place of fear, of interest rates, of foreclosures, of market crash, move us back to normal, because this has been a normal market for quite a long time. And we're starting to see growth happen probably faster than many of us expected.